When SoFi reported its quarterly financial results for the first quarter of 2025, I have to admit I was pleasantly surprised. Of course, I've had SoFi stock rated as a buy all year long, and I've been bullish on this stock, but I was not expecting such strong results for the first quarter in 2025 because of all the macroeconomic headwinds the US economy faced during that period. So I wanted to elaborate on what management said about the business so that investors can understand what's going on with SoFi stock right now.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
SoFi CEO started off his discussion by saying, "We're off to a tremendous start in 2025." And those were not words I was expecting to hear from the SoFi CEO coming in a first quarter where the President of the United States implemented tariffs on its trading partners, which created a significant slowdown in economic activity. I was expecting SoFi to take a more cautious approach, take a more cautious stance on this discussion because of those headwinds. So I was pleasantly surprised to see the business off to a tremendous start despite those headwinds. The company accelerated its revenue growth to 33% and profits increased by more than 3x. They added a record 800,000 new members in the first quarter, which drove 34% year-over-year growth, and it now has 10.9 million SoFi members. And this is one of the reasons why I've been bullish on SoFi stock. The value proposition they offer customers, I see as being so much better than traditional brick and mortar branches. Those banks that have those locations in communities across the US are not serving those people in those communities as well as they could because they're not staffing those branches effectively. They're not training those staff members that they are putting in those locations effectively. And so they're not utilizing those very expensive brick and mortar locations. It's very expensive for these banks to have those locations. And instead of maximizing the value that they provide in those locations, they've kind of pulled back in a cost-cutting strategy for several years now. And you can, comment in the section of this video, in the comment section, and tell us your experience, because in my experience, and for most people I talk to around here in Los Angeles, when they visit these branches, it's an awful experience. There are long lines, and if you need help from someone other than a teller, those offices or those desks are usually empty. When you do speak with somebody at the location, they don't have the information you need, or they're not capable of serving you the products that you need. They need to talk to somebody else, or you need to get on a phone. For instance, few of these branches have mortgage officers there or loan officers there. So if you want to get a home loan, you probably won't find a home loan individual at these branches. You would have to do that over the phone. And so that begs the question, why do you have these expensive branches to begin with if you're not going to have people there to serve the products that you offer your customers? If you're only going to offer these products online, then why do you have these branches? Why are you paying so much to have these branches? SoFi doesn't have that. And so it can use its capital, it can invest its money and resources into things that people are looking to buy, people are looking to have, right? Those kinds of products, financial products and otherwise, that people are looking for. If it's going to be online anyway, then competitively, SoFi has an advantage against those legacy rivals because it's not weighed down by the capital that's required of those brick and mortar branches. And it will be difficult for those brick and mortar branches to change that strategy. It will be difficult to say, we're going to invest in our team members, we're going to increase staffing in these locations, because it's going to be expensive. The wages that they will have to pay to staff those locations and retain and train these individuals, given that we have record unemployment here in the United States, and they're going to have to offer attractive wages to get people to join. It's just a difficult slog for those legacy banks. I think they've made a misstep and created an opening for companies like SoFi to step in. So the company said they had their highest growth rate in 5 quarters, and they are really trying to enhance the financial services and technology platform segments. Um, to a lesser extent, yeah, it's kind of like how Tesla really tries to convince investors that they're an AI company, right? Before they even have really any AI revenue. A small fraction, I would say, of their overall business is AI revenue coming from the people that are paying for supervised self-driving. But the vast majority, 95, 98% of its revenue is probably non-AI, but they still try to convince investors they're an AI company. In a similar fashion, SoFi wants to convince investors that they're a financial services and technology company, and they don't want investors to look at them as a lending company. And for the same reason why Tesla tries to convince investors that they're an AI company and not a car company, because AI companies, for investors, those trade at more expensive valuations. Car companies are trading at forward price to earnings valuations of single digits, right? Like 5, 6, 7. Whereas AI companies are trading at forward price to earnings ratios starting at 20 and going as high as 200. So that's why Tesla wants you to think of them as an AI company so that their stock price can trade at higher valuations and the management team can get wealthier as a result of their ownership of Tesla shares. Similarly, but not as not as egregiously, SoFi wants you to think of it as a financial services and technology company. But the main difference being is that they actually have financial services and technology platform revenue. In fact, it's almost 50% of the overall business. And so it's understandable for them to make that case because they're like, it's half and half. And these segments are growing faster. So you can see that eventually these segments will grow to become a larger percentage of the business. It's more clear, it's more uh, developed compared to Tesla, which just, hypes it up instead of delivering actual products. So their financial services and tech platform generated revenue of 407 million, which was up 66% year over year, and the lending segment increased 27% year over year. And this was a surprise. I was not expecting the lending revenue to grow by this much, but it was driven by strong originations for third parties as well as strong originations from its own for its own balance sheet. The appetite from investors to buy up these loans has been great. Interest rates are high. SoFi focuses a lot on personal loans, which have rates of returns in the double digits, 12, 13, 14%. And so lenders are attracted to these rates of return and they want to buy up these loans. They want access to these loans. And SoFi is benefiting from that appetite from lenders in its products. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.